It's a major alert. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, they're dumping everything, and I'm going to show you who the big seller is and why the buyers are quickly running out of ammunition, which is why you need to act now, because as you're about to see, things with the U.S. economy are changing quickly. Plus, we have a sponsor for today's show. We'd like to welcome Above Food, who's going live on the NASDAQ under the symbol ABVE tomorrow, Friday, June 28th. They're a regenerative ingredient company, and if you've ever wanted to trade an IPO, here's your chance. And keep in mind, the biggest opportunities are usually in the first few days. Again, check out ABVE on the NASDAQ. Now, let's head over to Zero Hedge, where we picked this story up, courtesy of Goldman Sachs. As they say, the party is almost over because hedge funds are dumping record amounts of tech stocks to retail investors. And you might remember, looking back years ago, hedge funds were sellers and retail investors were buying, and they beat the pros. The retail investors did this. I'm going to show you why this time the hedge funds might be on the right side of the trade, as retail investors are running out of ammunition to keep buying stocks. And looking at the daily melt up in the big five mega cap stocks, whereas Goldman observed 2 weeks ago, the biggest 5 names are now taking turns going at runs at all-time highs. This is now creating a problem in the markets for retail investors who want to buy at all-time highs and hope the market goes higher. Meanwhile, hedge funds are dumping in a big way. And here's the reason retail is buying these 5 stocks: because they're outperforming the index and the equal weighted index in a big way. And now that could change, because we could see a huge amount of selling. And keep in mind, we're in the corporate share buyback blackout window, but there's some other factors that are maybe weighing on hedge funds' mind, which retail investors can't see at all. But now we're going to show you what they're looking at, because one would think that both hedge funds and retail investors are scrambling to buy up this latest AI bubble. Turns out only one of them is. The other is dead wrong. As we look at retail flow specialist Vanda Research writing in his latest market note, the second quarter has been marked by an extended and acute lull in retail trading activity, as individuals' subdued purchasing activity in U.S. markets has become somewhat of a puzzle lately. And keep in mind, when retail investors start running out of money, well, that's where the peak of the market's going to show up. This time, hedge funds believe they've got it timed just right. And yet, despite the apparent buyer strike, none of the hallmark signs of retail capitulation are present. And that's true. Retail investors want to buy at all-time highs and hoping the market keeps going higher. In fact, buying of levered long ETFs continues unabated, while liquidation selling is missing. At the same time, most markets-focused sentiment measures point to above average levels of optimism, and that's true. Investors really believe that the market's going to go much higher and pull the economy with it. The problem is, you're about to see the economy's headed in the wrong direction, and that's usually not a good sign for stocks. The last time we saw a comparable period of retail underparticipation was during the second half of 2017, according to Vanda. And look at the conditions, because they're very different now. You go back to 2017, what do we see? Systematic positioning, retail, and long-short funds, they were not maxed out on their positions. Meanwhile, retail cash levels were very high. And look at now, we see mutual funds, they're very long the market. We know the systematic machines are very long the market. Long short, they're long as well. And retail, they're running out of cash, and that's the critical part, because when they don't have the ammunition to keep buying the market, well, that means without corporates, and we could see a big change in that in the coming quarters. As earnings and profits go down, they're going to cut back on their buybacks, and the biggest buyer in the market's going to go dark. And without retail buying, well, it means we're set up for a big fall. And more importantly, Goldman notes that hedge funds have aggressively sold TMT stocks in the past month, led by semis and semi-equipment, along with NVIDIA. In fact, is showing below this month's net selling by hedge funds, and US TMT is tracking to be the largest in the Goldman Sachs Prime Book record. So they're big sellers here and handing stocks right over to retail. And this is a problem, because retail investors, they say at past bubbles they've learned from their lessons and they're going going to know this time to get out. But look at this, because retail investors, they're buying at all-time highs. It's normally what they do. And when you look at the top 10% of stocks by size versus the entire U.S. stock market, you can go back to 1928 and then again here in the 90s, and you can see market cap concentration among the largest 10% of U.S. stocks. Well, we are in bubble territory, and retail investors just can't get enough. But things for the U.S. economy are changing in a big way. Let's first take a look at Walgreens before we get into the data that came out today. And their stock plunged as drugstore chain slashed profit guidance in a challenging consumer environment. And that's likely what we're going to start hearing this quarter in earnings. It's only going to get worse in progressive quarters. And let's take a look at what Walgreens had to say, because retail sales for the quarter fell 4% from the prior year quarter. Now, keep in mind, retail investors believe the market's going to go higher. Companies are going to make even more earnings and larger profits on the back of U.S. consumers. Walgreens is saying, no, they're not buying at all. In fact, they're saying this is a challenging retail environment, among other factors. And we assumed in the second half that the consumer would get somewhat stronger, but that is not the case. In fact, that's what everyone believed. They heard the Fed, then they told the world the second half is going to be great. We're going to achieve a soft landing or no landing scenario. And investors said, we believe in you, Fed. And they dumped their money into the market and drove stocks higher. But the wealth effect didn't show up to consumer pocketbooks because they're not spending. Now the risk becomes to the downside, and you start to see some of the reasons why hedge funds are selling. They added that the consumer is absolutely stunned by the absolute prices of things, and for good reason. They can't afford them, and the fact that some of them may not be inflating doesn't actually change the resistance to the current pricing. And what that's indicating is that paychecks are shrinking, something we've talked about. Workers are not getting the number of hours they want. Their wage increases aren't big enough, and so that means they have to cut back their spending, because we're seeing other factors. We'll talk about what's going on in the labor market here in a bit, because there's changes there too. So we've had to get really keen, particularly in discretionary things, because that's where the spending is dropping off. Consumers are trading down. They're only buying now what they need to buy, and this is a big problem for the equity markets. As you can see here, when we look at advanced retail sales, you want to talk about what drives earnings and profits for companies. Well, it's moving products, but investors today, they don't seem to be concerned about that. And when we look at that against the NASDAQ 100, we can see slowdowns or decelerations in retail sales often lead into a recession, and that brings equity prices down. And you can see that happen here again in the global financial crisis. Caused a bit of a problem around 2015, 2016, started to bring stocks down around 2019, and even the big drop here in 2022, well, that was retail sales coming down. Now we're seeing this head down even lower. Maybe we'll likely see in the months to come a potential contraction. Meanwhile, stocks continuing to go higher here as retail investors are bullish as ever. And as we look at the data today, we see treasury yields fall after U.S. economic reports. Well, why is that? Well, things did not look as good as everyone thought. The final estimate of the first quarter GDP has been revised slightly higher, and the 1.4% reading is solid. But this indicates that economic growth is slowing, and this is a key point. You want to understand why interest rates go down? It's because they're a function of growth and inflation expectations. We're seeing economic growth slow. We're seeing inflation start to cool off even further. And what this means is rates need to come down because they're at a restrictive level. They're too high, and you're starting to see that from Walgreens saying, look, consumers are balking at current prices, and even though we're not increasing them, they have a problem. This is an issue in a debt-based economy. Consumers need to be able to borrow and spend. Right now, we know rates far too restrictive. And more importantly, the personal consumption data is showing a slowing in the consumer, down 1.5% from 2%, and that is a cause for concern, something we've talked about. And again, we mentioned that how consumers, their paychecks are shrinking. That means they have less money to spend. And we're seeing fractures in the labor market, as we'll talk about here in a bit. And all that leads is to less demand at a time when supply is rising in a meaningful way. The data show little demand across major categories, and if not for autos, the print would have been even worse. Recent demand momentum for AI products and other new technologies has been one bright spot, but the overarching theme from the regional Fed surveys has been tepid CapEx intentions. And companies aren't likely to put money into CapEx if they're not seeing growth, they're not seeing demand, because they're going to start getting worried about their bottom line. And here we can see from UBS Global Wealth Management, growth matters as much as inflation, and it does, because easing price pressures and other economic considerations should encourage central banks to start or continue cutting rates. And he's right, even though the Fed says maybe we're not even going to cut this year, and that's a problem because the Fed doesn't realize they are going to be cutting this year. You're now seeing the early signs of the U.S. economy decelerate, and wait till I show you the labor market data. But here's something investors overlooked, and you didn't see this in the article by Bloomberg, is corporate profits quarter over quarter. Well, they're minus 2.7%. Remember, investors buy stocks on the expectations that companies are going to see increased revenue, earnings, and profits, and they're overlooking that profits now are starting to turn down. And when you look at corporate profits after tax against the NASDAQ 100, that's shown in red, what you can see is slowdowns in corporate profits or even declines in it lead to bad things for stock prices. We see that again during the dot-com bubble, the global financial crisis, again in 2015 into 2016 when retail sales went down. And now look, we see a little bit of a slowdown way up here in 2022. The equity market came crumbling down, and now corporate profits, as of the last reported from the government, are about where they were before. But look how much higher equity prices are. Investors thinking that profits are going higher, and companies like Walgreens are saying, wait a minute, this isn't likely to happen. And the official government data is saying, well, wait a minute, no, companies are making less money. That's typically what happens when demand falls. Even commodity trading advisors, or CTAs, which of course many of you know we have reports that mimic those, they use trend following strategies, boosted exposure in NASDAQ 100 futures to such stretched levels that the so-called stop loss triggers have become very tight. This according to Bank of America. From where things stand, CTAs can start unwinding their positions if the gauge's futures drop 2.8% or more. A month ago, the pain threshold hovered near 4%. So once again, we're in the midst of the buyback blackout window. Hedge funds are selling. Retail investors are running out of dry powder. And now the CTAs could be big sellers. But this biggest problem for the U.S. economy is just beginning. As U.S. recurring jobless claims rise to the highest since the end of 2021, and this is something I've been warning about, when we can see initial claims and continued claims go higher, it means spending power of workers is getting eviscerated, because once they're on unemployment, they're going to have to cut back their spending in a big way. They've already got issues with cost of living increases that are hitting their income, but on unemployment, they've also got these big debt payments because interest rates went up, spending gets cut, more people lose their job. You're now seeing this. Continuing claims, a proxy for the number of people receiving benefits, is now increased to 1.84 million in the week ending June 15th. Meanwhile, first-time claims clicked down to 233,000 last week. And notably, hiring has slowed significantly from the pandemic recovery era of widespread labor shortages, and the unemployment rate ticked up last month to 4%, which the Fed says it's not going to go any higher, but well, we know it is. For the first time in 2 years, economists and the Federal Reserve policymakers are watching the claims data for signs of whether the labor market, which so far has been surprisingly resilient, is continuing to soften. And it is continuing to soften, and it's going to be in a meaningful way, because it's going to lead to a further slowdown in the economy. And for the equity market, that investors believe cannot continue to go higher. They believe it only goes up, it doesn't go down anymore. Well, watch out, because Goldman Sachs chief economist said the labor market is reaching a potential inflection point where a further material softening demand for workers could lead to a rise in joblessness. This could not be more true as we look at initial claims in blue against continued unemployment claims in red. And we've been warning, if continued claims do not come down, they are a leader of initial claims. And you can look back all the way to the 70s here. You see continued claims rise and initial claims follow in each each and every instant. Now we're seeing continued claims nudging a little bit higher over last week, which is up over the week before, and that's going to start pulling initial claims higher. And at some point, it's game over for the U.S. economy and the stock market. And now you can get a picture of perhaps why hedge funds are so eager to unload to retail investors, because as continued claims go higher, as shown in blue, against the NASDAQ 100 in red, what happens? The market comes down each and every time, and we're seeing that happen, except right now, retail investors all in and everyone else looking to unload their positions as unemployment claims head even higher. In stocks futures, paired losses and bond yields rose after the data reinforced bets that the Fed will be able to cut rates later this year, because the market is starting to realize what the Fed can't see is that the U.S. economy isn't coming in for a soft landing. It's going to blow right through that to the downside. Inflation will come down. Everything's going to come down. But this time, it won't stop, even though the Fed thinks so. And a separate report Thursday showed that orders placed within the U.S. factories for business equipment, and I love this, unexpectedly declined. Well, if consumers have less money to spend, they're loaded up on debt, and they're starting to worry about losing their job, they're going to spend less, indicating firms remain cautious about investment amid higher for longer borrowing costs and softer demand, something people said wasn't going to happen. And sure enough, if you look at the labor market, you want to see what the Fed is watching. Continued unemployment claims, if they continue to head higher, the Fed is going to get nervous, and nervous very soon. We're talking now a potential cut somewhere around September. This time, continued claims, if they break out, look for the Fed to start to have a panic move. Of course, they'll say it's just for that we hit the targets or we're close to it, but they will indeed be cutting rates. And once they start, well, they're not going to stop as we head into the next recession, potentially all-out financial crisis. But one company that is poised to bring in money no matter what's going on in the economy is Above Food. You can find them on the NASDAQ under the symbol ABVE. Remember, they're going IPO this Friday, June 28th. Let's take a look, because they're a regenerative ingredient company, and they're doing big things. They're well situated to take advantage of macro forces, producing high-quality, traceable food ingredients. So you talk about this from a consumer demand perspective. Consumers are demanding products made by companies like Above Food, and they are the leader. I'll show you, they are the absolute leader. They're innovating regenerative farming practices and at scale, leveraging hard asset base with significant operating leverage. They've got a scale business with global distribution, and their agricultural practices and processes that build better still. They literally start with the ground up. This is a really, really cool company. Look at this from their disruptive ag. They're in 29 countries, 300 customers, and they process 300,000 metric tons per year. In the specialty ingredient space, they've got 4 patented technologies, 10 manufacturing platforms, and 260 customers. And in their private label, they've got 6 manufacturing platforms, 29 countries and distributions, and 35,000 points of distribution, making this IPO one that you want on your hot list. Again, ABVE. In the first few days, this is where opportunities happen. You need to keep an eye on it and jump in when you see it, because their objectives are to improve soil health and structure. Again, starting from the ground up, increase crop yields, reduce chemicals, fertilizers, and fuels. This is something consumers are demanding. Optimize water, improve nutrition and food quality, and improve carbon sequestration. This is a big company, and as I said, they're one of the leaders as their private label manufacturing facilitated in part through differentiated brands. They've got 6 own manufacturing platforms and 120 unique product formulations. And this is my point. When you look at their competition, they really have none, because their vertically integrated innovation platform drives superior products and business model. They've got everybody beat, making, again, an investment in Above Foods a big opportunity as they head into their IPO tomorrow, Friday, June 28th, on the NASDAQ, symbol ABVE. And here you can see Above Food is a high-growth business with projected fiscal year through January 2024 revenue of $482 million and adjusted EBITDA of approximately $23 million, representing 80% two-year revenue CAGR. Above Food has long-term adjusted EBITDA margin target of approximately 15%. 6%. And again, you can find them on the NASDAQ trading tomorrow, Friday, June 28th, under the symbol ABVE. And as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.